Hello, guys. I told you guys that if the Fed raised rates this time, it's probably going to be their last hike. Well, honestly, I'm watching the stock market take a tumble. Now, these guys, they've been buying on the dip, they're getting routed out now. And the guys that are out there now are starting to figure out you sell on the rally. They're just starting to figure it out now, and they're starting to get a little bit very, very nervous, investors. And this is exciting because you can see where they're starting to move, what places they're moving out of and moving into. I'll tell you what, the initial stages of this crisis we're in, and it's starting to unfold right before us. So let's get the markets open and take a look what's going on right now, right this minute. Okay, so the first thing we're going to take a look at is cryptocurrency. We're seeing the deflation hit right now, and we're seeing what's happening. They're unloading cryptocurrency, and we're seeing it fall. It's falling right now while I'm speaking, and it's falling quite fast. If we take a look and we move back a little bit, say to the 30-minute, we're starting to see this. It had an upswing while they were waiting for the Fed decision, and now she's turning downwards. Now we see the same thing happening with gold and silver. Let's take a look at the silver price. Boom. Boom. Look at that go down. It's the first time it's break through that range. It's down to 1454. It's broke through the bottom side of that range. It's heading down. And this is what deflation does. This is what a slowdown in the economy does. People sell off everything, and they try to move into something. They're trying to find some place to put their money, and the initial stages of this, they're going to run into the dollar, U.S. Treasury bonds. This is where they're heading, but later it's going to all change direction, because what's going to happen is the Fed at a certain point here is going to have to turn dovish. They're going to have to change their policies. They don't want to. They're really hanging on. Let me see. I had something up here we can take a look at. I had a picture here. Oh, here's the Dow right now. Let's take a look at the Dow. She's down 495 points as I'm speaking, and it's falling like a stone. It's falling like a rock right now. It's just falling out of bed, and nobody wants to catch a falling knife right now at this point. They're going to get scared pretty soon. Now, you remember my forecast. If you think back, remember my forecast. I said that the real fear is going to come in when the Dow hits 20,000. Well, boys, we're over halfway there right now. Over halfway there, and we're heading there fast. She's moving fast. Now, I had a picture up here. I think it might have been here on Yahoo Finance where I was looking at Federal Chairman Powell. I probably can't do it justice, but he had his face all pursed up like this. I wish I could find that picture. Find out where it was. I'd like to show you guys. Anyway, let's take a look at the dollar. Look at her shooting up. 97.04. She's climbing right now. They're racing into the dollar as a safe haven asset. Biggest mistake that they can make, because when this thing turns, it's going to turn fast. They're going to get trapped in dollars. And when it turns, we're going to see all these other asset classes that are falling, like Bitcoin starting to fall from this. I'm surprised how well Bitcoin is holding up and not actually falling out of bed. Silver's falling out of bed quicker, to tell you the truth. Let's take a look at gold real quick here. Okay, let's take a look at gold. Silver's falling out of bed real fast. Let's take a look and see what gold's doing. It's probably falling out of bed too. Oh yeah, look at her go down. She's down $6.70 on the announcement. They were waiting for the announcement to see what the Fed was going to do. The Fed said that next year they're only planning 2 rate hikes. They were planning 4. They're only planning 2. I'm going to tell you what, boys. There's a time coming very shortly where they're going to come out and announce they're not doing any rate hikes next year. Okay? They'll try that first. They're going to hang on as tight as they can, possibly can, to this quantitative tightening where they're withdrawing $50 billion a month out of the economy. They really, really want to keep that going, the Fed, and they're protecting that. That is their precious. That's their precious. And they'll do anything to protect their precious. And they will lower these interest rates before they will quit quantitative tightening. But it's quantitative tightening that's causing all the problem. Not the raising interest rates. Raising interest rates is part of it, but it's not causing as much problems as quantitative tightening. They're sneaking this quantitative tightening in and withdrawing 50. That was the money that propped this system up to begin with. They were injecting $80 billion a month into the economy during quantitative easing, injecting $80 billion a month in. And that's what brought the stock market up to where it is now. Right? From the Great Recession of 2008. What's going to be the effect if they start withdrawing $50 billion a month from? Now, they've been doing it ever since the start of this year, month after month after month. They've done it all the way through this year, and I've been warning about this. This is my timing for this disaster. I was preaching this disaster. People are saying, hey, it isn't coming yet. Glenn's wrong. He's full of baloney because it hasn't come yet. But what happened to me was I didn't anticipate that there was as much excess liquidity in the system that they would be able to draw from. There was more than I thought. And they were able to draw that $50 billion a month longer without nothing happening because there was excess liquidity sloshing around in the system. And that liquidity had to dry up. And I didn't know it would take this long for that liquidity to dry up. I thought it would dry up quicker. I thought it would be all gone by this summer. Well, it went through the summer, went through the fall, and they still had excess liquidity. It's just starting to dry up now, the excess liquidity in the system. And now we're starting to see the effects of quantitative tightening. Until they reverse quantitative tightening, along with lowering interest rates back down again. Just saying that they're going to stop raising interest rates probably won't be enough to stop this train. This train is starting to gather momentum, and what you're seeing right now is the momentum of this train of deflation. And that's why gold prices are falling. That's why the stock market is falling. That's why the real estate market is going to fall. That's why all of these bubbles that they blew up are now going to pop. The everything bubble. The longer they wait and the longer they let this get established and the faster this train gets going, the more energy it's going to take to stop the train. It's a runaway train. And the faster that runaway train goes, the more brakes it's going to take to stop it. They're going to have to stop it at a certain point because it'll destroy everything. It can cause such that even they don't have a position anymore. I mean, it's just unbelievable. It can turn the whole world into a Venezuela if they allow it to continue. They can't let it allow it to continue because they will be on the line. They will be held accountable. And people are starting to realize, hey, you know what? The Fed's accountable for this. The president has said they're accountable. They can't let this continue. Now, the big question here is when are they going to step in and put the brakes on? If they step in early and put the brakes on, it might not require as much, and we might not see such a bad deflationary episode. We're already in the deflationary episode, but it might not get a whole lot worse than this. But as soon as they put the brakes on, this is going to turn around from a deflationary episode into an inflationary episode. We're going to head right into inflation as soon as they put the brakes on this. They're going to have to put the brakes on this. So when we head into that inflation, you better not be invested in the dollar as much as you are. You got to divest yourself slowly out of the dollar, and the best time to do it is when prices are down. And prices are coming down on these asset classes that'll help you to diversify out of the dollar. You should have at least 5% of your portfolio in these assets that are diversified out of the dollar. At least 5%. Minimum 5%. And if you can, hold it in your own possession if you possibly can. You know, hold that 5%. And if you like cryptocurrencies, then put them on a cold storage in your own possession. If you like gold and silver, then get the real physical gold and silver and keep it in your own possession. That way, there is no counterparty risk. Okay? So it's all beginning to unfold right now. Thank you guys for listening. Like and subscribe, and we'll catch you in the next show. Bye-bye, guys.